This is Chapter 6, Video 2. Let's launch. Okay, so today's learning objectives, we're going to talk about describe different types of itemized deductions that are available to individuals, and also determine the standard deduction available to individuals. So as we talked about on the previous, so I think you guys might see the flow. And actually, if you take a look at a tax return, you'll probably notice that most of the way that we organize this course is that we kind of flow sort of from the top of the tax return, and we kind of flow down towards the bottom of the tax return. And we're actually at the point now where we've crossed the line. We have crossed the line. And now as a result of crossing that line, you are now in itemized deduction territory. Do. You have now crossed the line, and you are now in the itemized deduction zone. I know that's a really bad Twilight reference. Heck, probably knowing my luck, most of the people in this class have no idea what I'm talking about. Twilight Zone's a TV series from the 70s, 60s and 70s actually, and really good. But anyways, as a sci-fi nerd, I really enjoy it. Anyways, let's talk about some itemized deductions here, okay? So the first itemized deduction we're going to talk about is medical expenses. Medical expenses, as you might gather, they can be very expensive for people. So if you go and you go to the hospital, you spend an exorbitant amount of money. Now, most people will have health insurance, whether it comes from, if they're retired, they have Medicare. If they're disadvantaged, they have Medicaid. If they work full time, they'll have health insurance through their work. I know there's also a lot of jobs out there that don't provide health insurance, but then there's the healthcare exchanges where a lot of people can get that health insurance. And that's going to cover a lot of these costs. And then as we're going to talk about later on, there's actually a floor along with the medical expenses that usually prevents a lot of this deduction from being taken. Times where I think I see this deduction being taken more often than others is when people are fully retired. And what ends up happening is they have some kind of an ailment that Medicare only covers, a certain portion of. They got to pay for the rest. The other reason why they get this deduction is because they don't make very much in terms of recognized income. And as a result of which, because their AGI is so low, it lowers that threshold to where a lot of these medical expenses can become deductible. I would say roughly about 80-90% of the time that I'm dealing with medical deductions, and it's a deductible expense, it's probably somebody over the age of 65. Now, does that mean that nobody else qualifies for it? The answer is no. I do know that if you have a lot of other ailments and a lot of other things that, especially if you have a special needs child, I did have one taxpayer that did qualify for this because of a special needs child that they had where they needed to be able to do this. So there's a wide range of reasons why this will happen. The medical expenses that they talk about with this, so the taxpayers may deduct medical expenses incurred to treat themselves, their spouse, or their dependents. So if you have a child, you pay for their medical expenses, you can take a deduction as a result of that, and that's actually pretty good. Qualifying medical expenses include unreimbursed payments for care, prevention, diagnosis, cure of the disease, cure of injury, disease, or bodily function. Probably, one of the more common questions that we get in the medical industry is, I just had this kind of a procedure. Is it deductible? In general, anything that's seen as cosmetic or not necessary in order to do one of those things, a cure, prevention, diagnosis, cure of a disease, care, and bodily function, you're generally not going to be able to get a deduction for it. Now, I've had some taxpayers who argue, if I didn't have this laser hair removal, I wouldn't be able to do certain things. Yeah, okay, I get it, and there's some things that I get with that, but the IRS is pretty strict on this, and this is an area that if they see that there's a lot of deductions and you fall outside the norm, you could be subject to some pretty heavy auditing. So you want to make sure that when your clients are taking these benefits, these tax deductions, that they're actually taking them appropriately. You also can, for personal use of automobiles for transportation. This is where I think this is probably the least used standard, this least used deduction in medical expenses, period. And especially, here in the Washington, D.C. metro area, maybe from my house to the doctor's office is 5 miles. And maybe I go to the doctor's office once a month. I'm not going to write off 5 times 12, that's 60 miles. It seems rather de minimis, and as a result of which you don't have a lot of people who do it, especially because you don't get to use the business rate, which is around 58, which was 58 cents in 2019. I don't know what it is in 2020, but it's 17 cents a mile in 2020 for medical. And so therefore it's something that a lot of people don't deal with. I see this out actually in Midwest. I have a very good friend of mine who has a mother that lives in Oklahoma, and he has to drive her to like 4 different doctors all across the state in order to get all of her Medicare stuff, because Medicare has various restrictions on some of the doctors that she can see. And so as a result of which, there's a lot of driving that happens as a result of this. And he has huge write-offs on this because he takes care of his mom and all the stuff that she's got to go through. Hospitals, long-term care facilities, you do get to deduct all of those. The medical expense limitation. So for this year, it is reduced by 7.5%. This fluctuates a lot between 7.5% as the floor and 10% as the floor. And initially, the 7.5% was supposed to go away. It got put back into the tax return. Here's how it happened. For many, 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 many years. I'm talking like from the year that I started doing tax returns until 2003, right up until I think it was 2014 is when they started increasing the rate. Maybe I'm wrong. Maybe it was 2012. In order to afford the Affordable Care Act, one of the ways that they did that is they increased the tax floor from 7.5% to 10%. Now, that might seem a little contradictory. If you want to make sure that people can get affordable health care, why are you denying a deduction? But this is one way that they paid for it. And so it is what it is. Eventually, when they did the Tax Cuts and Jobs Act in 2017, they lowered it to 7.5% for a period of 2 years. And then it was supposed to go back up in 2019, and they did some legislation that made sure that didn't happen. And I think a lot of that has to do with, it's not, this is a senior citizen type thing. Again, I don't want to talk politics, but for the most part, senior citizens tend to be very active politically. And since this affects them more often than not, this is an area where they really hammer on. And so you'll see a lot of times where politicians are going to talk about that we need to make medical deductions allowable for a lot of our senior citizens. And so this is actually very important. Again, like I said, most of the time that you're going to run into this are going to be some of your senior taxpayers. All right, so taxes themselves. Now, is where we're going to talk about taxes. State and local taxes, real estate taxes, commonly called property taxes, personal property taxes. Personal property taxes like your car tax if you live here in the state of Virginia, and if you live elsewhere, there are other states that actually do this, mostly on cars. They also do it on other types of things. Businesses have personal property tax, but of course that wouldn't go here. It would go on Schedule C. But, you kind of get the gist. So and these are what we call SALT, SALT, stands for state and local tax. Okay, so state and local tax, you'll notice that they say foreign tax. I'm going to talk about that here in a minute, but state and local taxes, as of the Tax Cuts and Jobs Act of 2017, have been limited to $10,000. And if you are married filing separate, that goes from $10,000 to $5,000. If you're single, it's $10,000. If you're married, it's $10,000. If you're a head of household, $10,000. If you're married filing separate, $5,000. That's how you need to know this. I have put this as a trick question on the exam just to kind of see if people are paying attention. So you might want to make sure that you make sure that you keep good notes on that. At the time of shooting this video, I haven't actually redone the entire exam yet, so I don't know if I'll put that on there or not, but it could be a question. You want to know that. Okay, and I'm sure that they actually asked this on the CPA exam also, because it is a place where it could be trickery. Because if you think about it, if I'm single, I should get $5,000, and if I'm married, I should get $10,000. That's usually how things work, and I could go into why it ended up being that way. I don't think it's going to get changed anytime soon. I thought this was going to get doubled from 10,000 to 20,000 when we saw the House of Representatives switch over to the Democrats. It hasn't happened yet. But because I know a lot of people that were really affected by this tended to be in states where Democrats tend to be very popular. And as a result of which, I actually expected this to be changed. I don't expect this to last forever, because I think there's going to come to a certain point where people are like, this is not fair, blah, 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 and all that stuff. Again, not trying to talk politics. I'm just trying to kind of give you a little bit of background with this. This has been a very controversial tax provision for many years. And so I would hope, not hope, but I would actually expect it to change. You can also do the sales tax deduction. Okay, so if you live in a state like Florida, Texas, Washington State, where they don't have an income tax, but they have a sales tax, you can use a sales tax instead of an income tax, and that actually is permanent in the law. Many years ago, it was a temporary provision. It did become permanent many years ago, and it's now there. Now, I mentioned that state and local taxes, so SALT, is actually limited to 10,000. Foreign taxes are not. Now, we don't talk about tax credits in this class just due to time, but you have the foreign tax credit that you can take. And 9 times out of 10, you're going to go ahead and do that foreign tax credit. But if you find out it actually works out better to do the foreign tax income, the deduction, this is where you would put it, but it is not subject to that $10,000. So you need to make sure that you understand that. And there's been a lot of discussion about that. Why is that the case? Blah, blah, blah. But again, we're here to deal with what we got. Poker player. I play the cards I have, not the cards I want, and that's how we have to deal with this. All right. So interest, there's 2 itemized deductions for interest. You can have interest for your home, and then there's also interest for investments. Okay. So interest for the home, on debt acquisition before December 17th, you can take up to $1 million of indebtedness as a deduction. Anything from December 15th and on is down to $750,000. Now, I want you to understand, if you have 5 mortgages, you got to average them all together, get the average balance of all those mortgages, add them together, and if they're more than $750 or $750,000, you have to be able to take you're going to have to shift some of that over to personal interest, which is no longer deductible. Now, some people ask why December 15th? It was the date they wrote into the law. I think it was because they expected it was going to pass a little sooner, and they expected it around that time, but they chose that date because I think another reason why they wrote that into the law is they didn't want to create a 6-week time window or how many ever week time window to have people like stress out and try to get things done as typically does. But they set it into law to make sure that it was pretty static. All right. Charitable contributions. If you donate money to a qualified charity, normally 501c3s, generally within the United States, there are a few foreign countries that you can make donations to that you can still get it. It's a little bit outside of the class, so I'm not going to get too much into it, but there are some times where it can work out. You'll need to look into those rules and find out which countries it is, because it does change. There's certain countries that come up and fall off, and so that's why I'm not going to go into it too much right now. But you make money or property to a qualified domestic charity. Special rules apply to contributions of property depending on type of property. So you have capital gain property, ordinary income property. There's going to be different types. There's levels for 50%, 30%. And what you want to do, if you have somebody who 9 times out of 10, if they're donating cash, it's a 50% contribution. There's no ifs, ands, or buts. But there are certain types of other types of contributions that are 30%. Now, what is this 50% and 30% that I'm talking about? That's the limit of your income that can receive the charitable deduction. So if I have adjusted gross income of $100,000 and I donate $40,000 of a 30% asset to a charity, I can only take 30% of my $100,000, which is $30,000. I donated $40,000. I take $30,000 my deduction now, $10,000 goes off into next year. Okay. So you want to make sure that you're following all of that in order to get that taken care of. Okay. And that's what we just kind of talked about. They did increase it from 50 to 60%. I did forget that. That is actually true. To be honest, I've been doing taxes for 20 years. I only had one client that ever came close to the 50% limit, was at 50%. I think people who are going to run into this problem more than anything else are going to be retired. They don't have a whole lot of income. They have a lot of wealth. They want to donate to a church or to another 501c3 that they have a lot of respect for, and they donate and they over donate, and as a result of which they have to carry forward. And it's our job to explain to the client why they don't get it immediately. Actually, so we're kind of in this 3-step thing. I'm going to let you read these steps. To be honest, 9 times out of 10, the computer's going to do it for you. You're not going to calculate this on your own. But at the same time, it's good to know why it happens, because we don't just go back to the taxpayer and say, oh, I'm sorry, I didn't understand why you didn't get this deduction. I just let the computer do it. Oh, I'm a fraud. Here's your money back. That's not how we do things. We try to understand what's going on. So make sure you're looking at this. Try to have an understanding of how this happens. Between you and me, though, 99 times out of 100, this isn't going to even be part of a conversation that you're going to have with your clients. All right, so summary of contribution limit rules. I'll let you read that on your own time, or if you want to do a pause to take a look at it while you look at my smiling face. That's about the best smile I get. I have a small mouth, so unfortunately, when I smile, it's not like a Tom Cruise kind of smile where he smiles and the room lights up. I smile and it's kind of like, oh my gosh, he looks like he's crazy. So we're not going to deal with that. Other non-itemized deductions, non-deductible, unreimbursed business expenses, tax preparation fees. So under the old rules, you used to be able to take those deductions that are listed in the non-deductible as a subject to 2% itemized deduction. 2017, they got rid of it. Now, it's a got rid of provision that only is temporary. In 2025, these become deductible again. So I'm expecting now, my personal opinion is one of two things is going to happen. In 2025, they're going to let these be deductible again, or they're going to basically say, hey, we figured out that we don't really need these. We're going to make this permanent. And I'm not going to lie to you. It's going to depend on who's in charge at the time. They'll make a decision as to whether it's good or not. And I'm sure the IRS is going to weigh in. Hey, we've saved this much money in audit preparations because we don't have to look at these 2% things anymore. We'll see how that all works out. But I do have a lot of clients. In fact, I would say the people who got hurt the most by this, if you take a look at the investment expenses. So look, I'm going to see if I can point to that in here. So if you look down at the investment expenses, and you'll see investment expense. Who do you think pays the most in investment expenses? Is it a person who's 20 years old making $100,000 a year? Because they just graduated college. I say 20 years old, 25 years old, $100,000 a year because they just graduated college and they got a high-powered engineering job. Are they going to be paying that? No. The majority of the people who pay investment expenses are going to be retired individuals. And those are the people who really got it hard hit as a result of this, because what happens is they take all their money, they put it with these financial advisors who are doing their job, making the money. And it used to be that their financial fees were deductible. They're not deductible anymore. And so that's the thing. Tax preparation fees, as far as I'm concerned, that was the biggest slap in the face that happened as a result of this law. Again, I'm not supposed to be kind of putting out a whole lot of value to whether they did the right thing or not. But the tax preparation fees, obviously, I remember somebody had put out a PowerPoint as an accounting firm, things that were going to change. And they said, this is un-American. I'm kind of thinking to myself, wow, that's a self-serving statement. But tax preparation fees are no longer deductible either. Deductible are gambling losses. Now, why do we let people deduct gambling losses and not investment expenses? There's just certain things in this world I don't know, folks. Maybe Congress will begin to realize, oh wow, we need to throw in investment expense. I don't know. We'll find out how it happens. But it's only to the expense of gambling income. So if you lose $30,000 but only win $100,000, $30,000, and you only win $1,000, you only get to deduct $1,000. Those other deductions that you did are lost. And of course, if you're losing that kind of money, my question is, why are you doing the gambling in the first place? But again, I'm not supposed to establish value on this. When I talk to my clients, the thing that we try to do is get the max tax deduction out of that. I have asked one client before who said, is there a carry forward provision with gambling losses? And unfortunately, the answer to that is no, you cannot take that. All right, casualty theft loss on investment property is definitely, they're subject to certain rules. Used to be, and I think it probably still is, subject to a 10% AGI floor. And then on top of it, they take another $100 off, because it's like, after we took 10%, we're going to take $100 off more. and take it off away from you, but that's kind of how they do that. And then unrecovered cost of a life annuity at death. That is, I was 20 years. I don't think I've ever seen that, but that doesn't mean they don't exist. I'm sure it was probably more prevalent in the 80s and 90s when life annuities were seen more common. This is where they talk about the standard deduction. Now, here's what's going to happen. We just went through all the itemized deductions. You're going to prepare the tax return, and you're going to take it, and you're going to look at it, and you're going to say, okay, I have this much in itemized deductions. Actually, let me do it in the camera. I got this much in itemized deductions. I've got this much in standard deductions. I'm going to take the bigger of the two. Okay, and that's usually what will happen. 99 times out of 100, you will. Now, as I talked about in one of my previous videos, sometimes you might want to look at this, because here's what happens is when you do this and you record, and say, for example, you take the standard deduction at the federal level, most states force you to take their standard deduction at the state level. That may not be in the best interest of the client. So you may want to take a look at that and see if there's an opportunity for you to find some additional savings for your client otherwise. I just had a client just recently. That thing just happened. We took the state deduction versus we forced the itemized deduction. We elected to take the itemized deduction instead of taking the standard deduction, and overall saving them around $500. Sometimes that'll end up happening. And of course, when he has to pay my fees, he's going to remember that, and hopefully he pays his bill faster this year than he did last year. But, that's kind of how we deal with this, okay? So married filing joint, there are the numbers. Additional standard deduction if you have an age or blindness at the end of the year. So if you're blind, you get an extra $1,300 if you're married filing joint. If you are over the age of 65, you get an extra amount. And so that'll end up happening. It's actually a question that gets asked on your tax return preparation software. Were you over, they'll calculate the age because they're going to use your birth date anyways, but is a taxpayer blind? If that's the case, they get an extra standard deduction as a result of that. All right. So as they talked about here, for individuals that are dependent on the others, the standard deduction is the greater of $1,100 or $350 plus earned income, not to exceed the standard deduction amounts for those dependents. Yeah, I'm not so, I would think that most of this is just to prevent unearned income shifting that normally happens. So one of the tax planning strategies that they would have if there were no tax provisions in it, you could take income. So say, for example, I got a person who makes, $500,000 a year, and they've got unearned income of around $100,000 a year. I could shift some of that income by giving investments to one of my kids, and then they're going to be able to take that income on their tax returns at much lower rates. The kiddie tax actually prevents a lot of that from happening, and so as a result of which, you may have to take into consideration some of the kiddie tax implications to find out how that works out. But I think that's the only reason why they did it this way, is just to prevent income shifting, so that rich people can pay less in taxes just by shifting it to the kids. All right, standard deduction. You can bunch itemized deductions. Tax benefits can be implemented by simple tax timing. I had this actually with a client once where we were doing, we were planning their tax returns for the following year. And we said, look, next year you're going to itemize. The following years after that, they were going to be standard. There's no way they were, because I think they were selling a house or something like that. And the person said, look, we got a whole bunch of money, but we don't want it. We're going to give it to a church. Should we wait till next year or this year to do it? And I said, do it this year. You have a bunch of itemized deductions that are going to allow you to take the deductions now. You take the charitable contributions to go with it, you'll get a tax deduction on it. If you wait till next year, that money is not going to give you a tax benefit. And so we ended up doing some tax bunching with them. And that was actually a very helpful method for us to be able to save the client. I think we ended up saving around $3,000. So it was a good deal. The basic strategy consists of shifting itemized deductions into 1 year, blah, blah, blah. That's exactly what I explained to you. And so that's how that kind of works out. All right. So that's all I got to say about itemized deductions. So I want to say thank you very much for showing up to class, and I look forward to seeing you in the next video.